Hello and welcome back to Crosstalks. For those of you joining us now, we're live from KTH, the Royal Institute of Technology here in Stockholm. Crosstalks is a collaboration between KTH and Stockholm University, and on this program you have a unique opportunity to not only listen to, but also engage in discussions with distinguished Swedish and international professors, as well as thought leaders from around the world. All you have to do is log on to your Skype account and call us. We are called Crosstalks TV. Wherever you are, do get in touch. It is now 5 years since the collapse of the US investment bank Lehman Brothers, an incident that marked the symbolic beginning of a financial crisis that large parts of the world are still struggling to recover from. Today, the financial market itself seems harder than ever to fully comprehend. Extremely complex derivatives and different kinds of high-frequency trading are just two of the many reasons why. Questions are indeed being raised concerning who, if anyone, actually oversees this system. Currently, about 70% of trades on the US stock market are performed by robots. This is a market to which a majority of our pensions and savings are connected, a system which we've seen experiencing obvious challenges at a huge cost to businesses and causing tragic losses for private citizens as well. With us in the studio to discuss whether algorithms in the financial markets are helping or hurting us, please welcome Britton, Professor in Mathematical Statistics, Stockholm University; Henrik Hult, Associate Professor in Mathematical Statistics, KTH; Björn Hagströmer, Assistant Professor in Finance, Stockholm University School of Business. Welcome. And via Skype, joining us are Simone Foxman, reporter at Quartz, calling from New York City, and Mao Yi, Assistant Professor of Finance at the College of Business, University of Illinois, Urbana-Champaign. Welcome to Crosstalks. Henrik Hult, can you briefly explain what an algorithm is and why they increasingly seem to be affecting our lives?
Yeah, an algorithm is basically a recipe. So in the context of finance, what you do is you gather some piece of information, and then you have some recipe to transfer that information into an action. So you want to buy or sell an asset on the financial market. And
so what would it be concretely? Would it be a piece of code or an equation, or?
Yeah. So what people do today in the electronic exchanges that we have today is that you get some piece of information, and then you have a computer program placing an order for you in the financial exchange, and speed is essential for these kind of algorithms because if you can act faster than your competitors, then you have an advantage.
So it's an expression of a mathematical formula, basically, which acts in the market.
Yes, or it's just a computer program taking some piece of information.
Very good. And why are they playing such a large part of the financial market today?
Now we have these electronic exchanges, which means you have computers placing orders for you. And then if you can act faster than competitors, you have an advantage. You can buy at a cheaper price or sell at a higher price because you act before others have acted. So it's if you have an efficient algorithm that can make correct decisions for you, and it can do it very quickly, then you can make money from it.
Yes.
Yeah, maybe Henrik could correct me, but a very simple algorithm, just to be specific, could be that whenever the stock value goes below some threshold, I buy a certain amount of stocks. So whenever my favorite stocks goes below a certain value, the algorithm says then buy, and this is programmed into a program who does this.
Okay. I get that. And in that case, but what we're talking about, of course, would then be things that are incredibly complex. So if they'd be monitoring a bunch of stocks and a complexity, a massive amount of values and so on.
Just like cooking, just like when you cook, there are simple recipes and more complicated recipes.
Mm-hmm. Björn Hagströmer, you've focused your research on high-frequency trading. So just very briefly, what is that?
Well, high-frequency trading is a set of strategies that are part of the wider term algorithmic trading. So algorithmic trading is what we just heard. It's automatic responses to events in the financial markets. And you can use those for all sorts of things. And financial institutions, you can distinguish that they sometimes trade on behalf of their clients, the client telling the bank to buy or sell shares, or the bank can trade for their own money. And this is a common distinction that high-frequency trading is the part of algorithmic trading where the bank is trading for their own money.
Okay. Is it actually faster, hence the name?
The name can be confusing because they are fast, but the high-frequency traders are not necessarily faster than the other algorithmic traders. So there are algorithms all over the financial sector today. There's hardly anyone active in the financial markets who don't use algorithms for some part of their business.
Okay.
But another thing that we can say about the high-frequency traders is that they tend to use algorithms for all parts of their business, from processing information that they gather in the markets, to making a trading decision, and then finally to execute that trading decision in the market, to go to the market and trade.
So it's a historical name and it's not actually faster. Very good. In that case, I wonder, I'm sorry, I'm just shooting out the massive questions first. Is the growth in high-frequency trading part of why the financial markets crashed in 2008?
So why the financial markets crashed in 2008 is a huge question, but high-frequency trading back then was not as big as it is now. So I think it's very unlikely that it caused the crash. And I would say that the financial crisis of 2008 was mainly due to problems in the real sector, combined with very complex financial assets that aggravated the problems. But it's in the real economy, the problems started, and high-frequency trading is something that it's hard to see how it can have a large impact outside the financial markets.
I am a little bit worried. Are you just talking with your scientist hat when you're saying it's incredibly unlikely? Does that just mean no in layman's terms?
Yes.
Okay,
that means
good.
No.
That means that was not the cause. Very good. Tom Britton, these algorithms produce mathematical results. Do they achieve what they're meant to do?
Are you now asking about the financial sector or in general?
If there's a distinction, let's talk about it. Does an algorithm always, is it built into the context that it always does what it's meant to do?
There are a lot of algorithms around. Of course, some of them have sort of mistakes in them which are not meant to be there. So it's mistakes by the people programming or by the people thinking about the algorithms. But then there are algorithms that are around, and the alternative to an algorithm is sort of a non-automated way to make decisions, and I don't think that they need to be better or worse. So it's hard to say. That's my simple response, I think.
Professor Mao Yi, does anyone have control over the algorithms, especially when we're speaking about algorithmic trading? Does anyone in the world today truly understand what is happening in the financial markets?
Okay, for the first part, I'm sure somebody could truly understand the algorithm and have control over algorithms, because people who design them should have control over the algorithm. Actually, through my research, you can find when there's some like macro announcement, actually, many high-frequency traders actually shut down their machine. Actually, that means somebody control them, right? And about the second part is like, is there anybody truly understand this financial market? Oh, this is a very broad question. My first answer is like, it's complex. That's number one. Even when I talk with some high-frequency traders, I mean, they don't understand what other high-frequency traders are doing. That's number one. But in another sense, I mean, I can say it's, I'm an economist because I do not design algorithm. But from an economic incentive point of view, actually, it's not that complex, okay? So I think, can you hear me?
Yes, we can, absolutely.
Okay, great. Think about why we need speed. I can give you 2 examples, which is, very true. For example, one of my research to find what's the origin of high-frequency market making. Actually, high-frequency, why people compete on speed, right? That's an interesting question. I find it's like people compete on speed when they can no longer compete on price, okay? I give you one example. In the United States, the tick size is 1 cent for all the stocks, right? So that means low price stocks actually have a very high tick size compared to the price, right? So basically, you cannot quote less than a penny. In some cases, for example, if you want to quote like 1 cent bid-ask spread, right? Actually, equilibrium bid-ask spread is 0.5 cents. You know 1 cent make money, and I also know 1 cent make money. But who can get the goods? We need to allocate the resources. So what allocate resources? Actually, speed, right?
Yeah.
So if you are faster, you are first in the queue. If you are lower, you are later or slower in the queue. So your order get executed, and my order cannot get executed, right?
That's right. Yeah.
So, but the other part, which I don't think the expert is how to implement, how to be faster. Then that's the question for scientists. Which, as economics, my focus is like I study incentives.
All right. And of course, part of that, again, as we'll talk about a little later, is a technological answer, and it has to do with things like fiber optic cables. Simone Foxman, you're a journalist at Quartz, and you cover the future of finance, regulation, and financial technology. Do you trust the stock market?
Well, I think that's a big problem, is that there have been enough problems in the stock market, whether you're talking about the flash crash, whether you're talking about glitches that shut down different trading outlets. There have been enough of those problems that it makes it difficult for people, at least in the US, to have complete faith that some software glitch, some faulty algorithm somewhere, even a server is going down isn't going to suddenly lose them a lot of money. So I think it's hard for people. I think you have to trust it if you're an investor, because you don't really have many alternatives. But I think that's something that people are questioning more and more.
What about you personally, though? Do you believe the system works?
I think the system works, but I think there are problems.
Okay. Henrik Hult?
I mean, in terms of the algorithms, they don't live a life of their own. So it's every algorithm is programmed by somebody who has some idea what it's supposed to do, and it's usually supervised by a human who makes sure that it does what it's supposed to do and not acts in strange ways. So it's not like we have artificial intelligence robots sort of slowly taking over the financial world.
But we are letting them do things for us.
We're letting them, they're helping us in that way.
A group of scientists have found that high-frequency trading bots operate too quickly for, well, it is of course obvious that they're for too quick for us to track. We rarely react in less than a second's time. A modern high-frequency trading bot can prepare trades in just, I have to look up the number to get this right, 740 nanoseconds, giving time for over 1 million trades before the humans in the room notice that anything has happened. Does this benefit investors? I mean, this is all of this invisible trading that the humans working in this can't have time to process. Is it good for us?
If you turn to the academic research, the answer is that it actually does benefit us. Even though we can't comprehend what is going on there, most studies who look at high-frequency trading and ask the question, is this good for market quality? Market quality is then stated in terms of transaction costs. How much does it cost for us to go to the market and trade? Or market efficiency, so are the prices that we see in the market correct? When you ask those questions, most studies find that market quality is improving with the activity of high-frequency traders.
Do you all agree that this is good? Simone?
Well, I would actually say, and I'm familiar with this specific study, what they were saying was that because high-frequency traders are able to purchase data feeds that aggregate market data, they're able to make decisions faster than the actual market structure. If you're an exchange, you have to process data through a central clearing mechanism, and that's slow. So high-frequency traders can operate faster, meaning that they can execute at slightly better prices. This isn't something that you, as a normal investor, if you said, oh, I want to go buy shares of Facebook, that's a long decision for you. You've thought about this for a while. You're not going to see the minimal price changes. Whether you get this within a cent of each other is not going to matter to you. But for institutional investors, your pension fund, you might see a difference over time if you're operating. The high frequency traders are getting a better deal, and I think that's hard. This is a market structure problem, though. Again, this is something that's regulatory, and that needs to change, maybe.
Yes.
I think the purpose with the fast exchange is that you provide liquidity and you lower transaction costs. So it's always good for everyone that if you want to sell, then you can sell. There is a market. You can go there, you can place your order, and it will be executed. It's not like selling your house. It will take you 6 months before you find the right buyer. So having an exchange where trades are pretty fast is good and reduces also the transaction costs. But at some point it becomes quite ridiculous when you have to act within a few microseconds or so, and it's only about having the fastest computer. Then you can make money, and of course when you can do that, people crowd into that and try to reduce speed as much as possible to make money off of that. And the addition or the benefit of that to the economy is quite small, I would say.
Maji?
Yeah, can I add one point? I think most, so when I hear here, my sound echoes. Is that on your end?
No, yeah, it sounds great here.
Oh, it sounds great. Okay, great. So I have some slightly different view about that. I believe most of my colleagues' previous study, but most study actually does not happen at the nanosecond level. So I believe when speed increase at a very low frequency level, for example, if you change that to a minute to a second, there might be some social benefit. But I have some research I find if you goes to nanoseconds, actually, the effect is neutral, because in nanoseconds, there's no public new information, anything else. In that world, only relative speed matters, right?
Okay.
For example, if you have microsecond technology, I have nanosecond technology, and I can make the market, you cannot, right? And you try to beat me, and you design some picosecond technology, and then you make the market. I cannot make the market. But the overall effect through my research at the nanosecond level, it's zero.
But
if you consider,
yes.
Do I have a question?
Yes. Well, I wonder, does this not mean that inevitably everybody will just try to trade faster and faster? That will happen, don't you think?
Yes, this is actually, in economics point of view, is called a positional arm race. Actually, people want to become faster, but at some point you just want to be faster than others. And when you become faster, other people fight back. This is it's like raising rats, actually. I think at some point at the nanosecond level, I don't think it improves liquidity, but I didn't say it harms liquidity. The effect actually is neutral. It's like it doesn't matter.
The gentlemen in the room look worried. Yes, who first? Björn? Henrik?
Well, it's also, I mean, one can think about regulating the speed allowed at the exchange, for instance, to make things, say, fairer for those who doesn't have the technology to be the fastest. But then the problem then is that if some exchanges allow faster trading and some will have slower, then people will move to the faster one. So it's not like we can ban fast trading in Sweden and have then just investors will go somewhere else because they can reduce costs slightly so.
I agree with Mao that there will be a race to be the fastest among those who pursue these high-frequency strategies. But I think your question is also about whether this is a problem for the slow traders.
Yes.
So is there a conflict between the short-term and the long-term horizons? And so if I'm a long-term investor and say I decide I want to buy Ericsson shares today, and the price today is 85, and my objective is perhaps that I can sell the shares in 1 year at 100 crowns. Then I can go to the exchange, do my trade at 85 or something like 85, and if my scenario comes true, I can sell at 100 a year later. What the high-frequency traders are doing, they might buy Ericsson at 85.00 with the aim of selling it at 85.01. And they are doing that at the same time as I, as a long-term investor, is pursuing my goals. So that may have the consequence that I either buy my shares at 85.00 or 85.01. And to the long-term investor, that doesn't really matter. That is such a small difference. But that's the difference that the high-frequency traders live off. So the high-frequency traders will compete to do that little trade about 1/100th of a Swedish crown. But I don't see that it's a conflict towards the long-term investors because they can pursue their strategies anyway.
The reason I look worried is that I, from school, I still carry with me this idea that, and of course also the idea that market value means something in the real world, that it has some kind of connection to assets and prognoses and what is happening with the production of certain goods or services. And what a long-term investor is talking to that kind of information. It suddenly seems to me that a high-frequency trader is a kind of parasite on this system that doesn't produce anything except money. And I realize I probably sound incredibly anti-capitalist as I say this, but I'm just trying to translate this to universally understandable language. Simone, you look like you have a response for this.
Yeah. I mean, I think that there have long been people who profit from being a middleman in transactions. And I think that that's the purpose of high-speed trading in general. What it has brought about is access to liquidity. And you used to have different kinds of market makers that would perform that same role. I think that, when you're talking when you've changed these into electronic actors, you've just changed the calculus, and that's introduced some new problems. They can run away from the market when their data tells them to, and that wasn't the function of old market makers. So you have to change your thinking about what their role is and maybe what they have to do.
Okay, I realize also that I was being incredibly fair to everybody who makes money off money. For instance, that is what banks do, and they are completely vital to the system, of course. Yet there is this feel that if I mean, for instance, why don't we just do only algorithmic trading? Would that be a good idea, Tom?
I'm not as a specialist in the financial market as my colleagues are, so you might pass it on, the question on. But we're only discussing this short-term dealing. But I think an important aspect here is also the complication of the products sold on the market. Maybe some colleagues here can add to this, but the products you can buy and sell are increasingly more complex nowadays than they were before, and I think that could very well have been the reason for the financial crisis some time ago as well.
But is there something fundamentally unhealthy about saying, okay, we're just going to take this huge chunk of our universe and just let the computers talk to each other? Is that a bad idea? Because you all make it sound so uncomplicated. If algorithms are this great at trading, why don't we just let them do it and let the guys in suits go play golf or something?
Well, I would say that. I'm sorry. I would just say that a lot of the things that led to the rise of electronic trading were really positive and somewhat democratic. You used to have more of an old boy network where you'd make deals, and it was a lot about handshakes and who you knew in the exchange. Now a lot more people have access to investment, and that I think is a good thing. I think it brings a whole new slew of issues and problems, but I mean that's the beauty of the internet, the disruption that's going on in the technological world in the last few years, and this is no different.
Tom.
I think they are playing golf now because, as I learned, the number of people working in the stock exchanges dramatically reduced since the last 10 or 20 years. Maybe not as much in New York, if I understood correctly, but definitely here in Sweden, the number of people working on the stock exchange doing the actual trade has reduced.
Mm. Yeah.
I think that's what I meant. In that there's less going on behind the scenes that the normal person can access. There's different things going on behind the scenes, but your general access to markets is a little bit more straightforward. There's better information.
Simone previously mentioned something called the flash crash of 245. This was 3 years ago. Something incredibly dramatic happened in the US stock exchange, but we don't call it the flash crash of what's 3 years ago, 2010. We call it the flash crash of 245 because it happened sort of within a minute. Björn, can you explain what this is?
Yes. So this had its origin in a market for E-mini futures written on the S&P 500 index. So S&P 500 index is one of the most important equity indexes in the world, and these are contracts traded on that index. And on that day, one mutual fund, I think it was, decided to sell a very large amount of such contracts. Actually, they decided to sell contracts to a value of $4 billion.
Was that a human decision?
That must have been a human decision. Yes. But the execution of it, the actual trading is done then through an algorithm that when you trade such a huge trade, then you want to split that trade in many small trades to get a better transaction cost. And the consequence here was that other traders realized that this was a huge trade, and they don't want to keep their contracts if this large trade is going to push prices down. So many other traders started to sell at the same time, and this created a vicious circle, you can say that. And actually, the index fell by about 9% in a very short time, just within minutes.
That means value disappeared, about a tenth of the value.
And then just 20 minutes later, the market had recovered and was up this 9% again. So if you were at lunch at that time, you could have missed the whole event. But for those who were in it, it was a very dramatic event because losing 9% is enormous.
But when you say the other traders reacted, did humans in fact react, or was it just other algorithms that are out looking at the same trades automatically triggered other events that triggered other events?
Yeah, there are many algorithms out there who look for such events all the time, trying to see what other people are doing and react to that. And that is why the seller is using an algorithm to try to hide what he's doing, because he knows that the others will be watching. So algorithms certainly reacted. I guess that humans reacted too, and that there are many who, for example, have a stop loss limit that if the price goes through a certain price, then you have to sell to cut your risk exposure to that price. So there must have been human decisions in there too.
But this is not, as far as I understand, the way the market is meant to operate. This was an error in the system. Was this a mathematical error? Tom, I'm looking to you again to explain.
The actual event, I don't have much to say, but I think there is this tendency that people don't behave independently, so they look very much at each other, what they're doing, and the effect of that is that the fluctuations may be much larger than they would in many other situations. So, for instance, some of the mathematics behind the theory for stock values over time comes from statistical physics, and there it is used for many particles moving in some gas, for instance. And then a particle here moves completely independent of another particle here, whereas in economics, people don't behave independently. They look very much on each other, what they're doing. So the effect of that is that the system is much more chaotic in a sense. And also I think there are another difference between physics, where much of the mathematical theory comes from, is that there are some huge particles that can themselves influence the whole market. And that's not the case in physics. The particles are pretty much of the same size, but here there are some actors that can go in and buy very big shares that actually affect the price dramatically, I think. So that's these two effects, I think, have an effect on the market, for good and for bad.
That is incredibly interesting. So then the human error becomes in being sort of too scientific, so to speak, to treat this system as though it is in fact only a mathematical, it's only a theoretical construct. And there are, of course, thousands, literally, of physicists working in the financial markets in all the big trading centers doing exactly what you describe. Henrik?
Well, it's if you think of the complexity of the market, if you look for an individual investor who has his own algorithm program there running at the exchange, then of course you understand what it's supposed to do, and it is pre-programmed how it should act in different scenarios. And so it's the cumulative effect of all these algorithms together that's hard to predict what is going to happen. So that's what we saw in this flash crash, for instance, that many algorithms triggered by the same kind of events, and they triggered each other, and causing a chain reaction. And those are the kind of events that are difficult to predict. What will happen with some other event in the future when algorithms tend to react, that you understand the individual algorithms, but not the full picture in the collection of algorithms.
This must change the cultural valuation of how citizens and small-time investors view what the financial market is, because when there have been big crashes and big panics, for instance, afterwards, when the damage is done, you can do an analysis, or you can read some reporting about this and understand the psychological processes that led to a bunch of people making small bad decisions that cumulatively has a disastrous effect. But that would be very difficult for us to accept, I think, if it's code that has hooked into each other and just built a machine that breaks something this vital, because of course we all depend on this system.
Well, there has been crashes before the electronic exchanges, like the Black Monday in '87, for instance, was a similar event. The market recovered quite quickly afterwards, but it was a huge loss on one particular day for no particular reason. So it's this phenomenon that is not only due to us using algorithms now. It's a chain reaction that can happen that we don't fully understand why it's happening.
We do use algorithms every day in all kinds of other fields as well, to select films and rental services, and everywhere where computers are involved in our decision making. Of course, we do that, and that's more and more daily. Do you think this will normalize it over time? Do you think that we will get used to the idea of not actually being in charge? Simone?
I think we will. I think there's. I think data and the excessive amount of data that's out there requires computers to be able to break it down for us. In terms of the market, I think what people are really concerned about is that other people know more. They're just better informed, and there's no way your average Joe on the street is going to be able to understand markets as well as I don't know, someone at a bank or in a high frequency trading firm, and it makes you very scared to want to invest in anything but a broad market index because you don't really know what's going to happen. But I mean, in terms of the idea of algorithms in daily life, I think that's inevitable. I think as we get more technologically savvy, there's just more data and more stuff to process.
But there's one big field where it is not trivial that the man on the street does not understand this field, and that, of course, is regulation, because it's very likely that our decision makers also don't understand this. And in fact, I guess I should ask rather if most of this trading is happening too fast for humans to even notice, how can we regulate it, if at all? Is it possible?
I think the regulators are behind, and that's what we've seen a lot in the U.S. They're, just 2 steps behind for a number of reasons. Either they're not funded well enough, or they just don't know. I think that was a huge revelation in the financial crisis, that there were a lot of signs out there, and people were just not clued into them. I think it's going to take new thinking and maybe more transparency, maybe data just more available to everyone, so that at least it's out there, and market forces can be allowed to enact market discipline.
Mao Yi, do you think these markets can be regulated, or this trading can be regulated?
Sure, it can be regulated, but several conditions need to be satisfied. I think as one of the guests mentioned to you, is like a big data problem, right? So high-frequency trading really generates lots of data. If you want to regulate the market, first you need to have the same capacity as high-frequency traders. So it's like I'm not a regulator. I just analyze data exposed, and I need to apply grants from national science foundations, extreme science and engineering discovery environment to analyze the data. I think for regulators, it's the same. That's the number one. Number 2 thing is to exactly understand the. Does my sound echo in your end?
A little now, for the first time.
Okay. Is this way better?
Yes, thank you.
Okay. This is better.
Yes. So the second thing was?
The second thing is to really understand how algorithms work. Because, I mean, I don't think it's like there's some clear, you cannot make good regulation without actually understanding what they're doing.
So the problem, the challenge here, I guess, is that our governments would have to recruit people that are more expensive than the people who work for the financial institutions. And this is a bit of a practical challenge, yeah.
Yes. Without, through my experience to analyze the data exposed, without a supercomputer, you cannot even analyze the data exposed. Let alone simply, I mean, monitor the market in real time. You need to have extremely good supercomputing power and well-functioning code to do that. And the second part is like, without understanding what they are doing, sometimes, I mean, you don't know how to regulate. I can give you one example. So it's related to one of my research. Okay. So in the United States, there's an older regulation saying if you trade less than 100 shares, you don't need to report. That makes sense in old times, because in old times, there's lots of bookkeeping costs, right? And people trade less than 100 shares, mom and pop, right?
Yes, that's right.
So you don't need to regulate. But think about it. High-frequency trader can slice their orders less than 100.
Of course.
To escape.
So that would have to be changed. Yes. We have a question. We have a question from Skype.
Yep.
I think. Do we have a question from Skype? Yes, we do. Hello. State your name and ask your question, please. Hi.
Is it me?
Is it you? Dave, it says on the screen. Hi, Dave. Where are you?
Yeah, my name is Dave Lauer, and I was a high-frequency trader, actually. I was trading during the flash crash, and it was a shocking event. My question is around regulation NMS, which in the U.S. has really spelled the genesis of high-frequency trading. It was around in forms before that, but NMS was a really fundamental transformation of markets that has spawned the widespread adoption of high-frequency trading, but it was created before high-frequency trading was really known or understood by the regulators. So does anybody in the panel think that the U.S. is capable of fundamental overhaul in terms of getting rid of NMS, and are regulators around the world really capable of confronting the structural issues, the issues around complex systems that lead to high-frequency trading and that have led to this fragile market prone to technology problems?
I think we should ask first what NMS is. Simone, can you explain it briefly for the world?
I think Dave did a pretty good job of explaining it. Essentially, it allowed. It's a pretty complex thing. So
let's go to the answer. Can this be changed? Can American regulators revamp their system? Björn?
I think one of the main features of Reg NMS is that there are now many trading venues where you can trade the same stocks. Is that right, Dave?
That's a big part of it.
Yeah.
So NMS really meant that you had to go get the best price in the market. You were forced to. It's led to a lot of complexity, and it's led to a lot of different exchanges that aren't necessarily providing any additional value. It's sort of competition for competition's sake rather than for innovation's sake.
Mm.
Yeah. So we have had a similar regulation in Europe called MiFID that also allows many different trading platforms. So you can trade the same stocks in many different places.
Yeah.
And one thing that Simone mentioned was transparency. And I think that's an important point, that we need to make data publicly available in some way so that we can see the trading that is going on at the different exchanges at the same time. Because when one financial supervisor is monitoring one financial market, they miss a big part of the game when they're not seeing all the other trading venues.
That's right.
So we need a way of seeing all the data that is relevant at the same time and synchronized so that we can see what is going on. Then we have the big data problem that Mao is referring to that needs to be sorted out as well. But making the data available would be the first step, I think, towards understanding and monitoring.
That's right.
If I could add to that
Yes.
slightly, one of the, I suppose, if you're not super, versed in this, one of the ways in which Reg NMS works is, and the way that you have to get the best prices. So exchanges are constantly sending out the data to the central. It's called an SIP, the central processor, that is supposed to send back like the national best bid and offer price that exists, and so that it spits them back. But it spits them back more slowly than some of what the competitors get. So talk about a high frequency trading firm, any high speed firm is aggregating all that data almost as if it were like another SIP, and understanding how to interact with retail or institutional investors better than and faster than this SIP is sending back that information. So an algorithm is kind of well, not an algorithm. A high frequency trader is deciding to accept your bid or accept your ask, knowing that the national best bid and offer that was put out there at specific time might be better for you than what you're getting. So it's immediately turning around and almost taking advantage of you for pennies. And that's kind of one of the big ways, and that's the way in which the study that was referenced before argues that normal investors are being taken advantage of, and that's a market structure problem. Even though financial firms invest tons of money in keeping the system, quote unquote, up to date, their incentives really aren't there to make this process, this market structure, work in a way that would take away some of their profits, and maybe be the fairest system.
So I take this, Dave, these answers in aggregate to mean that it needs doing, but it doesn't look super hopeful at this time. Thank you for your question. Yes,
can I add one point?
Yes, absolutely.
Actually, it's a very interesting question. I think Dave also. So instead of talking about regulating high-frequency trading, actually some regulation and NMS actually I think is one of the driver for high-frequency trading, because in regulation NMS there is some kind of called sub-penny rule. That means you cannot quote sub-penny. That means for low-price stocks like City before the reverse split, actually the tick size is quite wide. So because people can no longer, because in regulation AMS, there's a rule said the minimum price increment is 1 cent. For stocks like Google, it doesn't matter. But for low price stocks like City, it matters because 1 cent is before they reverse split. I mean, because 1 cent is a huge tick size for low price stocks. So if people can no longer compete on price, people compete on speed. So I think actually one of the regulation, I mean, it's not regulation, it's deregulation. I think one good idea is like for low price stocks, we actually should decrease the tick size.
All right. Thank you. That would be one constructive suggestion there. Dave, thank you for your question. I wonder now, we're running out of time, but I would have to ask you, do you think that we will inevitably see more of this erratic market behavior in the future just because the system is moving in this way? What do you think, Björn?
I think the markets have to learn how to deal with it, and you may have to see this as a risk that such events occur, that prices are erratic for a short period of time. So you need to have it as a part of the risk management, that it's not a catastrophe for your portfolio if that happens for a few minutes. Mm-hmm. And I think there are good incentives in the market for dealing with these risks. My guess would be that those big price movements will be smaller in the future because people are not as shocked when it happens.
Okay. What about the others, Henrik?
Well, I think that the algorithms are getting better, also getting better at picking up this kind of behavior. Maybe over time one will see more stability in that respect. And it's also, I mean, things like the flash crash was a big deal when it happened and caused a lot of stir in the community, but the effect on the economy has been minimal. Mm. So it's not the end of the world to see those kind of events, I would say.
Is there a possibility, if we would let most of the trading be done between the computers, would that just not create like a completely fictional system with almost no connection to the real world? And would that add or decrease the threat to things like my pension savings and the value of my house? Tom?
Well, I guess the algorithms, the idea with the algorithms is to include actual knowledge into them. So otherwise, I think an algorithm without including information from outside will not be successful. So probably it's the algorithms that use the knowledge in an efficient way that will be most successful. So there is, I shouldn't be, it seems like you're worried about this word algorithm. It's sort of an evil word to you. I don't agree with you there. So if there are no algorithms, it's people put up their fingers, buy or sell, and probably it's better to systematize that into an algorithm, I would say.
In a big data world, humans are just not up to the job, essentially. Yes.
And the high-frequency trading, as we have heard, it's about the pennies on top of the fundamental value. So the fundamental value will increase or decrease over time, and that's what long-term investors are looking at. So the high-frequency part is a small part on top of that.
I think there's also an important distinction to be made between high-frequency traders, which are really concerned about events and making, a handful of pennies here and there, and just general algorithmic trading, which happens, based on a lot of human decisions, based on, programs written by humans that attempt to better understand the markets and just, make humans smarter in the way that they process data, just massive amounts of data that we wouldn't think of looking at in that way. So I don't know if that makes sense, but there's one end where there's the speed aspect, and that's the high frequency trading, and then there's just the general algorithms that help traders, as well as any kind of investor, even that's not trading at high speeds, better understand the world in which we live in.
I think that was an incredibly good clarification. That is also a very good point to end this conversation at. Our time for this talk on the stage is up. Of course, the conversation continues on Twitter directly. If your mind is overheated with information, do take a break for a few minutes. We'll be back on the hour to explore the unintended negative consequences of all our favorite communications technologies. See you then.